Everyone wants to know one thing right now. Are interest rates going down? Are they staying flat? Or are we quietly being set up for the next rate hiking cycle in 2026? Because according to Canada's biggest banks, they all agree on what's going to happen in the first half of 2026, but they violently disagree on what comes next. Let's break it all down. Here's the punchline. All six big banks in Canada now expect the Bank of Canada will sit at the current rate of 2.25% through the first half of 2026. No cuts, no hikes, just stuck here. But from 2027 onward, the forecast splits into two camps. Three banks think rates will go back up. Three banks think that we're going to stay here and that this is the new normal. But historically, only a couple of these banks have been consistently right. And I will point out that nobody is showing rates decreasing moving forward. And this matters if you're choosing between fixed, variable, or coming up on a renewal. So let's walk through the camps here. Camp number one is rates go back up. One bank sees the first hike as early as late 2026. Two others see hikes in 2027. Endpoint forecasts range from 2.75 to over 3%, 3.25% at RBC in Q4 of 2027. The logic here is simple. Inflation settles, growth reaccelerates, and the Bank of Canada is able to normalize. The other camp is where rates stay flat. The other three banks say 2.25% holds all the way through to the end of 2027. No aggressive growth rebound, just structural stagnation. And this is a quiet but important shift. Half of the banking system is basically saying this might be as good as it gets. Now, let's actually talk a bit more about who has actually been right before.